And a very good evening to all of you. Let me share my screen. So is my screen visible?
Yes, sir. The screen is visible.
Okay.
Please go ahead.
Yeah. So, today we'll be discussing the key requirements of the exposure draft in two standards that have been issued by the AASP of the Institute of Chartered Accountants of India. So let me give you a background. So most of the standards that are presently in place were issued almost 10 to 12 years or even more back. And barring a few exceptions like SA 570 on going concern, on SA 700 on audit report, these standards have largely remained unchanged. Uh, Now, over a period of 10 to 15 years during which these standards have been applicable, there have been considerable changes in the way we audit and also in the way the audit is perceived and the way the audit is being reviewed by regulators like NAFRA. So it was the need of the hour to revise some of the standards. India, being a member of IFAC, International Federation of Accountants, normally is expected to follow the standards issued by IAASB, and IAASB had revised some of the standard over the last 2 to 3 years. Consequently, the AASP of ICAI has issued exposure drafts of 7 standards. These standards are largely in line with the corresponding international standards in auditing. Besides these standards, 7 standards, there will be revisions in other standards also to conform to the amendments pursuant to the revision of these standards. One basic change in this has been a shift from the user terminology control to management. So we had a standard on quality control, which is now being replaced by 2 new standards, standard on quality management. And even SA 220, which we'll be discussing today, was quality control in the audit of financial statements, which has now been renamed as quality management for an audit of financial statements. The objective of these proposed new standards is to encourage proactive quality management at both the firm level and the engagement level. So while at the firm level, the guiding standard would be SQM1 and SQM2, at the engagement level, SA 220 is a primary standard, and there were consequential changes in SA 315 and other standards. The objective is also to promote a more robust, proactive, scalable, and effective approach to quality management. Now, when I use the word scalable, so it was largely known that auditing standards are applicable to audit of financial statements, irrespective of the size of the firm or the size of the entity that is being audited. Now, this concept has been reinforced in the revised standards by using the term scalability. So we'll discuss what scalability is, but we must understand that all the standards are applicable in totality to all audits. So let us look at the 7 standards that have been issued as exposure drafts. SQM1, which is quality management for firms that perform audit of reviews of financial statements or other assurance or related service engagements. This is the new standard replacing SQC1. SQM2 is on engagement quality reviews. Earlier, engagement quality control review was part of SQC1. So a new standard has been carved out of SQC and made a new standard SQM2. SA 220, quality management for an audit of financial statement. SA 250, consideration of laws and regulations in audit of financial statements. SA 315, identifying and assessing the risk of material misstatement. SA 540, auditing accounting estimates and related disclosures. And SRS 4400, agreed upon procedures engagement. So the first 2 standards are new standards, while the remaining 5 are a revised standard with change in name and the structure of the standard. The last date for exposure draft, commenting on exposure draft was 25th of August 2023. That date has already been passed away. So now the institute is in the process of reviewing the comments that have been received and making necessary changes as may be required. So let us move the first standard of that is the topic for our discussion today, which is exposure draft of SA 220 revised. This is quality management for an audit of financial statements. Now, there are three standards which are related. SKM1, quality management at the firm level. Then comes SKM2, which talks about engagement quality reviews. And then SA 220 revised, quality management at the engagement level. So all three standards are interlinked to a large extent. Right. So when SKM1 talks about the requirement of the firm to design, implement, and operate a standard quality management to management the quality of engagement performed by the firm. SKM2 talks about engagement quality reviews. The concept was already there in the form of engagement quality control review, which was a part of SQC1 and also SA 220. However, they have now carved out a new standard, additional responsibility for EQR, and also criteria for appointment and eligibility of engagement quality reviewer. Now, SA 220 deals with the responsibilities of the quality management at the engagement level. So first we have a base, which is the quality management at the firm level, and then we move to the engagement level. As a quick overview, the standard clarifies and strengthens the key elements of quality management at the engagement level. It focuses on the role of engagement partner in managing and achieving quality on audit engagement. So there has been a significant enhancement of the responsibilities of the engagement partner in this revised standard. It encourages proactive management of quality at the engagement level. We will see in subsequent slides how the standard addresses those. Standard aims to keep the standard fit for purpose in wide range of circumstances. So when we talk about scalability, whether the audit firm is a very small audit firm with engagement partner and a few staff, or a large audit firm with many partners, or the entity is a small entity with very limited operation, or a large company with multiple locations. So the standard tries to address wide range of circumstances where the standard would be applicable, how it would be applicable in different circumstances. There is an increased emphasis on the importance of professional skepticism. So if we look at the various orders and audit quality review reports issued by DAFRA over the last 2 years, there has been a lot of question on professional skepticism. The standard has emphasized on the importance of professional skepticism, and hopefully with the implementation of new standards, the points raised by NAFRA would get reduced and get addressed while we do an audit. There is an increased focus on documentation of auditors' judgments. So during the course of audit, we all make various judgments. So now the standard requires it to be documented more robustly. It was unsaid that anything you do in audit has to be documented, but now they have clarified that the auditor's judgment also needs to be documented adequately. So if you look at the snapshot of key changes, as discussed, increased responsibilities of the engagement partner, consideration of evolving environment, including changes made to the definition of engagement team to recognize different and evolving engagement team structure. This we will discuss in a subsequent slide, what the new definition of engagement team is. And when we talk of evolving environment, it also talks about intellectual resources, information technology. The standard considers the importance of professional skepticism and professional judgment in performing audit engagements. Scalability, we have already discussed. It is intended to be applied in the context of nature and circumstances of each audit. So we will discuss a little more in detail in a subsequent slide. This standard recognizes the growing role of technology in audit of financial statements. So when we talk of resources section in the standard, it includes technological and intellectual resources in addition to the human resources, which is presently in the current standard. And The standard also clarifies the relationship between SA 220 and standards on quality management, that is SQM1 and SQM2. Scope and applicability, the standard deals with specific responsibilities of the auditor regarding quality management at engagement level for an audit of financial statements and the related responsibilities of engagement partner. The standard has to be read in conjunction with related relevant ethical requirement, that is, for example, Code of Ethics issued by the Institute of Chartered Accountants of India, and the requirements of other acts like such as Companies Act, which prohibits taking up certain engagements. Applicability has not yet been notified. So if we try to anticipate, probably it would be applicable for the financial audit for the financial year commencing on or after 1st April 2025 at the earliest, because it is likely to be notified later in the year, and then probably Institute would come out with implementation guide on these standards. So earliest I can see is financial years beginning 1st April 2025, but it will depend on what the council decides. So when we talk of objectives of revised SA 220, the primary objective is to management quality at the engagement level to obtain a reasonable assurance that the quality has been achieved such that the auditor has fulfilled the auditor's responsibilities and has conducted the audit in accordance with the professional standards and applicable legal and regulatory requirements. So when we talk about professional standard, it would include accounting standards, NDAs, auditing standards, guidance notes issued by the ICAI. So there is a detailed guidance on what professional standard mean in the peer review guide that has been issued by the Institute of Chartered Accountants of India. So it has a detailed list what all are considered as professional standards. And the other objective is that the auditor's report issued is appropriate in the circumstances. That means if we have issued an unmodified opinion, then the circumstances required an unmodified opinion only, and it is not a case where the auditor should have given a qualified or adverse opinion but has given an unmodified opinion. So key changes in SA 220. So engagement partners' overall responsibility to manage achieve quality at engagement level is to be established through his or her sufficient and appropriate involvement throughout the audit engagement. So again, if we go through the various reports and orders issued by NAFRA, there have been a common observation in many cases that the engagement partner has not been involved in the audit as much as he or she should have been involved in the audit. So the standard seeks to address that, and it talks about three responsibilities of the engagement partner: leadership responsibility, direction, supervision and review, and a standback, which we'll discuss. So for the leadership responsibility, it says increase emphasis on the leadership responsibility of the engagement partner managing and achieving quality at the engagement level. So while at the firm level, there will be a managing partner or a similar person who is managing the quality at the firm level, the partner at the engagement level, it is the responsibility of the engagement partner to manage and achieve quality. Direction, supervision, and review. The engagement partner should determine the nature, timing, and extent of direction, supervision, and review in the light of engagement circumstances. So if the assessed risk of material statement is high, or it's a complex client, or it's a listed client, so direction, supervision, review would be significantly more as compared to the audit of a financial statement of a very small entity where maybe the engagement partner is directly supervising the work of a junior person. So that has to be a professional judgment of the partner. What is the extent of direction, supervision, and review? When we talk of standback, at the end of the audit before signing, the engagement partner should satisfy himself that his or her involvement has been sufficient and appropriate to provide basis for taking an overall responsibility for the financial statements. Now, paragraph A113 of the proposed SA 220 talks about indications where such involvement has been lacking. So, for example, the engagement partner has not conducted timely reviews. There is a lack of evidence that engagement partners' direction and supervision of other team members, which is again evidenced through sign-offs and communication between the team members. So it gives various scenarios which indicate that the engagement partner's involvement has not been sufficient and appropriate, and accordingly, the engagement partner needs to revisit entire strategy and ensure that the quality has been achieved. Scalability. So the revised standard includes material on scalability, as the standard is intended to be applied in the context of the nature and circumstances of each audit. So as I mentioned earlier, depending on the size of the audit, the standard can be modified, requirements of the standard can be appropriately tailored. So it can be applied for firms of all sizes, whether it's a small firm, a proprietorship firm, or a large firm. Again, there were practical challenges in the earlier standard in the absence of specific guidance. So, SA 220 has included certain paragraphs that highlight how the revised standard can be applied in different circumstances. So, I'm giving an example of paragraph 8, read with paragraphs A13 and A14. It says, when an audit is carried out entirely by an engagement partner, which may be the case for an audit of less complex entities, some of the requirements in this standard are not relevant because they are conditional upon the involvement of other members of the engagement team. So if we go to the standard, particularly the application material, which is starting from A1 to so there are various paragraphs regarding scalability at different sections of the standard. So there's a very detailed guidance how to tailor the requirements of the standard depending on the circumstances. So clarifying engagement partners' responsibility. So the engagement partner is required to take into account information obtained in the acceptance and continuous process in planning and performing the audit engagement. So this requirement is largely dealt with in SPM 1. SA 220 revised also talks about this. So when planning an audit engagement, or engagement partner should take into consideration the information that he or she obtained as a part of acceptance and continuance process. The requirements and the application material are more explicit about what the engagement partner needs to review, including a listing of examples of significant judgments in relation to the audit engagement. So when we talk about what engagement partner needs to review, the standard says there should be a review at appropriate stages of the audit in the entire period throughout the audit. When we talk about significant judgments in relation to the audit engagement, it would include, for examples that have been included in the standard, what will be the composition of the audit team, whether to employ or deploy auditors expert, what are the accounting judgments regarding accounting estimates, accounting policies, about going concern, and disposition of corrected and uncorrected misstatements that have been identified in the course of audit. So these are some of the examples of significant judgment which have been included in the standard. This is very important requirement that has come up in this new standard. SA 220 revised clarifies that ordinarily the engagement team may depend on the firm's policies or procedures unless the engagement team's understanding or experience indicates that the firm's policies or procedures would not be effective, or information provided by the firm or others indicates that the firm's policies or procedures are not operating effectively. Now, why this approach avoids the risk that the engagement team blindly relies on the firm's system of quality management. So I will give you an example That has not been given the standard, but what I can think of. Uh, so there is a firm policy on engagement quality review, right? The SQM1 and SQM2 together laid on the requirements. So towards that end, the firm has appointed another partner other than the engagement partner as a EQR or engagement quality reviewer for an audit of listed entity. Now the engagement partner knows that the other partner is a tax partner and is not an expert in doing an engagement quality review of the audit of financial statement of a listed entity. Now, it is the responsibility of the engagement partner to ensure that a appropriately qualified and a suitable person has been appointed as an engagement quality review and not rely merely on the system of quality management at the firm level. Because in this case, in case of a regulatory review, let's say by NAFRA, the engagement partner will not be able to take shelter that it was done as per the firm's quality management, because the engagement partner was fully aware that the such person is not competent in audit, that he may be an expert in tax or other areas, but he is not a suitable person for a EQR. So this is an example I can think of, and I think this is actually required because a lot of times people take shelter in the firm's policies, but now it requires to have an independent view of the engagement partner, because ultimately there is an enhanced responsibility and risk of the engagement partner. So it talks about professional skepticism is central to the quality management. So it includes material on importance of professional skepticism and professional judgment in performing audit engagements. So application material also gives various examples of impediments to professional skepticism. Some of these examples could be budget constraints, tight deadlines, lack of cooperation and undue pressure by the client or management, and insufficient understanding of the entity and its environment, right? The standard also talks about common threats and biases, which is conscious or unconscious. So, for example, common biases could be, we have been auditing this client for last 10 years. There has been no fraud. The CFO and the management is very honest. Their high level of integrity. So these are biases which are probably conscious or unconscious, and they have an impediment effect on exercising a professional skepticism. And the guidance is there on possible actions that the engagement team can take to mitigate these impediments. Next is also very important, change in the definition of engagement resources. So the standard recognizes that there are different audit delivery models and technology. So they have revised the standard to include that resources now include technological and intellectual resources, which are beyond the human resources. So if we talk about human resources, some of the examples can be the engagement team, auditors, experts, persons in the internal audit team who are directly assisting the engagement team. When we talk about technological resources, it could be data analytical tools like IDEA or ACL or any other tool. Even the standard even recognizes, tools for online meetings and communication tools that have been provided to the engagement team. And for intellectual resources, some of the examples are audit methodology, your checklist, your templates for maybe sample testing, and model audit programs. So these are all intellectual resources. As far as technological resources are concerned, the guidance includes, and the standard is that they should not be over reliance, and there should be caution against use of technology. Maybe irresponsible use of technology may also lead to a risk in the financial statements. A definition of engagement team has also been revised. Now, it says regardless of where individuals are located or how they are related to the firm, if an individual is performing audit procedures, then he or she is to be appropriately directed and supervised and the work reviewed in accordance with SA 220 revise. Now, to give you a few example, there are some large firms which have created service centers, where certain work is outsourced. So, for example, confirmation process or testing of bank reconciliation. So, uh, earlier, or they're based out of Delhi, and you have an associate or a network firm in, let's say, Mumbai, and certain procedures are being performed by a network firm or an associate, not a network firm, but you have a tie-up with a CA firm. So earlier, the standard was silent and they were not a part of the engagement team. So you subcontracted the work or something like that. But now the revised standard says even those individuals. So it says how they're related to the firm is not relevant. If they are a part of the audit procedures, then the engagement partner should ensure that their work is appropriately directed and supervised and reviewed as per the standard of SA 220. So I will just skip these. These are just clarificatory things. Documentation. So it talks about enhanced documentation requirement for auditor's judgment. So the revised standard says provide guidance on how the engagement partners involved in the audit could be evidence, or this could be done through sign-offs, through minutes of meeting with the other team members. So agenda items for discussions. So all these, we have been probably, doing proper reviews. We have been having meeting with the engagement manager or with the management or other team members, but probably they are not being documented. The revised standard requires documentation to evidence that there has been appropriate involvement of engagement partner. Then it talks about emphasis on documentation of the auditors consider judgmental matters such as circumstances that may pose risk to achieving quality on the audit engagement. So obviously SA 230 on audit documentation has to be complied with, and but there has been an increased focus on documentation as far as SA 220 is concerned as compared to the earlier version. Some other important points that need consideration. SA 600 guidance is there on interaction with SA 600, particularly in context of group auditing situations, and it integrates a new quality management concept in SPM1 and SPM2, such that concepts can be carried through at the engagement level as well. So we move to the next standard, which is SA 315. Identifying and assessing the risk of material misstatement. So if you look at the standard SA 315, so even the present situation, SA 315 is a so if you see the structure of the auditing standard, SA 200 series, 300 series, 400 series, 500 series, 600 series, and 700 series. So 300 series is risk assessment and response to the asset risk. So there are a total of 6 standards in this category. So we'll quickly see SA 300, 315, 320, 330, 402, and 450. Presently, only 315 is under revision. There would be consequential changes and amendments in the other standards pursuant to revision of SKM1, SKM2, SA 220, and 315. And other standards which are under revision. So the standard talks about new 5 inherent risk factors to aid in the risk assessment. It talks about subjectivity, complexity, uncertainty, change, and susceptibility of misstatements due to management bias or fraud. So these are all qualitative factors in assessing the risk. And there is a detailed guidance on each of these in the appendix 2 to the exposure draft of the standard. So there is a very detailed guidance. We will not go into the details. The objective being to give an overview of the standard. It talks about a new spectrum of risk at the higher end of which lies significant risk. So basically, it talks about the likelihood and magnitude when you are assessing the risk of material statement. So let me give you an example. So let us consider a very large company with a turnover of 2,000, 3,000 crores, multi-location, and a very high net worth, and cash-rich company with hardly any loans. So there is a cash balance of 2.5 lakhs, and it is in the custody of a cashier, and cash is hardly physically verified at any point of time. And the cashier has been there for almost 15 to 20 years. So here the likelihood of defalcation of cash is high because there is no proper control over cash. There is not physical verification or surprise check. But if we look at the amount in the context of the size of the company and the concept of materiality, the magnitude of the fraud is very, very low. So if we combine likelihood and magnitude, this is probably not a risk of material statement for this particular engagement as far as the auditor is concerned. Now, in a different situation, there is a retail store chain with a sale of lakhs of rupees every day. And the sales are both in cash and through credit cards. There is a system error. You can punch a credit card sale as cash or a cash sale as a credit card sale. There is no reconciliation at the end of the day. Whatever cash the cashier deposits on a daily basis is not verified, whether what were the cash sales and what were the credit card sales, what were total sales. There's no reconciliation, maybe once in 2-3 months or 4 months. Reconciliation is done for a few stores. Now, the volume of cash is high, and so the magnitude is high, and the likelihood of defalcation of cash is also high because there are no controls, and therefore it is likely to be a risk of material statement for the auditors because it lies at a higher end of the spectrum, which talks about high likelihood and high magnitude. The standard requires sufficient appropriate evidence to be obtained from risk assessment procedures as the basis for the risk assessment. So we have been talking about sufficient and appropriate evidence in the context of audit in terms of SA 500. There should be sufficient and appropriate evidence from the risk assessment procedures to conclude what the risk assessment has been done appropriately or not. So this again would require additional documentation to document whether these evidences are sufficient and appropriate to form the basis for risk assessment. The standard deals a lot on IT, particularly IT general controls. The standard talks about general IT controls, information processing controls, and IT environment. There is an appendix 5 in the standard, which is of 12 pages dealing only with IT related risks and how to address them. So 12 pages only on IT. Although, in the present environment, even the present standard is silent, IT environment has to be evaluated, and particularly after the introduction of audit trail, ITGC controls have become more relevant. So in a way, even though the revised standard is not applicable, certain ITGC controls and IT testing has to be done. And some industries like NBS and banking industries require, one of the partners or one or more partners to have a CISA qualification. So in a way, things are there, but now they have become more formal in the form of a new standard. So we need to be more conscious on that. There is more focus on controls relevant to the audit and on the design and implementation work required for these controls. There was a paragraph related to considering specific to small entities as a separate category. Now that paragraph has been deleted and the concept of scalability has been introduced. And so at various places in the application material, how the standard is scalable has been given due focus. So, and there are other changes requiring inherent and control risks to be assessed separately. Presently, the present standard allows a combined assessment of internal and control risk, and then talks about distinguishing between direct and indirect control components. So a direct control is control which is precise enough to address the risk of material statement, where the indirect control supports the main control. So to give an example, segregation of duties is a direct control, and promoting a culture of integrity and ethics is an indirect control, which supports the direct control segregation of duty, but it is not a sufficient control to address the risk of material misstatement. Again, a new standback requirement requiring reconsideration when material classes of transactions, account balance and disclosures are not assessed as significant but are material. So what it says is, uh, once you have done the risk assessment procedures and concluded a particular class of transaction or account balance or disclosure have not been identified as significant, but they are material, reassess whether there is any risk of material misstatement. So this is a new requirement. Again, if you ask me, indirect, somehow this was to be done, but this is now more explicit in the standard. The standard also has a very detailed guidance on considering the entity's internal audit function. There is a full appendix 4 in the standard, which talks about guidance on assessing the internal audit function. Let's look at the practical aspect. So this is an extract from an audit report, which is as per SS 700. Now the highlighted portion, we are giving a statement in our audit report, right? And SA 700 is applicable on audit reports of all entities, whether it's a LLP, it's a trust, it's any other non-corporate entity or a corporate entity. So the statement we make as auditors is identify, as a part of our audit, we also identify and assess the risk of material statement of the financial statements, whether due to fraud or error, design and perform audit procedures responsive to those risks, and obtain audit evidence that is sufficient and appropriate to provide a basis for our opinion. So in our audit report, we are saying we assess the risk of material statement. So in a way, we are duty bound to comply with the requirement of SA 315. Now looking at the scope and objective of SA 315 revised. So this standard deals with the auditor's responsibility to identify and assess the risk of material statement in the financial statement. And the objective is to identify and assess the risk of material misstatement, whether due to fraud or error, at the financial statement and assertion level. We will see what it means. Therefore, providing a basis for designing and implementing responses to the assessed risk of material misstatements. So in a risk-based audit approach, you first identify and assess the risk of material misstatement, and then design appropriate procedures and perform those procedures to address those assessed risk of material misstatement. So, very important concept in the standard is the audit risk. It says the risk that a financial statement contain a material misstatement, and the risk that the auditor will not detect such a misstatement. So this is the audit risk, how it plays. So we have 3 types of risk: inherent risk, control risk, and detection risk. We will see each of these in the next slide. At the interaction of these 3 is the audit risk. So if you say inherent risk, it is the susceptibility of an assertion to be a misstatement that could be material, assuming that there are no related controls. Fraud risk is a subset of both inherent risk and a control risk. So risk of an intentional act by one or more individuals. Control risk that the entity's internal control system will not prevent or detect and correct on a timely basis a material misstatement. And a detection risk that the auditor will not detect a misstatement. So inherent risk multiplied by control risk multiplied by detection risk is the audit risk. So SA 315 talks about these components: assertions, business risk, and significant risk. So I will not go into the definitions. We were given the standard. We all understand assertion, what is business risk, and a significant risk. So the significant risk is the inherent risk, which is close to the upper end of the spectrum of inherent risk, which we have already discussed, a combination of likelihood and magnitude. And the controls, again, we understand. So this is a pictorial diagram of what the standard talks about, how to do risk assessment procedures and related activities. These are largely in line with the existing standard, with few minor changes which are not too significant and are appropriate in the relevant circumstances. So I will not go into much detail due to consideration of time. So some of the procedures are inquiries, analytical procedures, observations and inspections. Then we have external factors to be considered, nature of the entity, what is organization structure, ownership and governance structure, business model, and others such as related businesses and business performance tracking. And the information can be gathered both from internal sources and external sources. The information could be financial information or a non-financial information. So when we talk about internal sources, it is financial statements, budgets, internal reports, MIS, minutes of meeting. External sources could be industry information, credit rating agencies, creditors, statutory authority notices. In case of non-financial information, it could be business strategies, organization structure, minutes, operating performance, policies, procedures, and manuals. And external sources for non-financial information could be trade association and industry forecast. So there are a lot of industries like automobile industry, which publishes forecasts on a regular basis, and there are trade associations, which also publish data on the industry. So another important concept that we need to understand is at what level should be the risk assessment done? So the standard talks about risk assessment to be done at two levels. One is at the financial statement level, and so I'm skipping because I have another slide on that. And it also talks about risk assessment at the assertion level. So let us discuss these. So when we talk of assertions, the present implementation guide to risk-based audit has considered the following assertions: completeness, accuracy, valuation, presentation, and existence. So yes, if we look at the various standard, it talks about rights and obligations, completeness, cutoff, but these can all be combined into these 5 assertions. And the institute has used these 5 assertions in the risk-based audit implementation guide, which was issued a couple of years back. Now, the standard says you have to assess the risk of material statement at the financial statement level. So when we say financial statement level, whether the risk of a pervasive effect on the financial statement, example could be a going concern issue. So going concern issue is a financial statement level risk. Management overhead of controls, deficient control environment. So when you are aware that the company does not have a proper control system, then it's a financial statement level risk. Integrity of the entity's management. So you are aware that the entity's management is not of high integrity, or the market reputation of the owners or promoters is not very good. So you assess the risk to be a financial statement level risk, or there are concerns about the condition and liability of entities record. So you know that all the entries are passed, just before the audit. There are chances of, missing some entry. So your whole audit approach and the response to the risk at the financial statement level will change. So probably you would deploy more senior people, you will deploy audit experts, you will have increased engagement partners time. So these are the financial statement risks. When we talk about assertion level risk, these are at the class of transaction, account balances, and disclosures. So for example, impairment of assets or provisioning against long overdue trade receivables. When we talk about disclosures, it could be disclosure of contingent liabilities or disclosures as per the standards, accounting standards, or disclosures as per Schedule 3. So why these have to be considered at different levels is because the overall approach to the audit will depend upon the risk is at which level. Right? Again, I will not go into detail of system of internal control. It is largely same. Control has 5 components, which is control environment, entities risk assessment process, the entities process to monitor the system of internal control, the information system and communication, and control activities. So largely the guidance is similar to what it is there in the current standards. Now, there is a requirement to have a discussion between the engagement partner and the key engagement partners. So this discussion would normally include the financial reporting framework, the susceptibility of entities' financial statement to material statement, identified risk. This is there in the present standard also. All team members need not be present in the engagement team discussion. However, when all the members are not present, the engagement partner shall ensure that what matters need to be communicated to other members has been communicated. So, for example, identify risk of material misstatement or materiality consideration of the overall audit strategy. So, to the relevant persons, the information has to be passed on. The standard requires that if the auditor obtains new information which is inconsistent with the audit evidence on which the auditor originally based the identification or assessment of risk or material statement, the auditor shall revise the identification or assessment. So, risk assessment is a continuous process. It is pervasive activity throughout the audit. At every stage, you need to reassess whether there are new risks or depending on the circumstances, the new fact that come to your knowledge or the audit evidence that you obtain. It's a pervasive activity. Documentation, again, there is a general principle. If not documented, this is not audited. So if we talk about documentation requirements, it should be a documentation of the discussion among the engagement team and significant decisions that were reached. What are the key elements of auditor's understanding? The sources of information from which the auditor's understanding was obtained, and the risk assessment procedures performed. This is very important to document. What was the evaluation or design of identified controls and determination whether such controls have been implemented? Identified and assessed level risk of material misstatement, the financial statement level and at the assertion level. Significant risk and risk for the substantive procedures alone cannot provide sufficient appropriate audit evidence, and the rationale for significant judgments made. Now, I have designed a template which we use in my firm, and also I've included a similar template in my book. This is ideally how you should be documenting the risk of material statement, which covers principally all the elements that are required to be documented as per SA 315. So it includes brief description of the risk. So you have to describe what is the risk, the type of risk, whether it's a assertion level risk or a financial statement level risk, the source document, how from where you have identified this risk, whether this risk is a fraud risk, what are the financial areas impacted, what are the assertions that are impacted, then the rationale why this risk and why the particular assertions have been selected, are there any mitigating controls, and finally, what are the specific audit procedures that need to be performed to mitigate those risks. So generally, this is a document that needs to be prepared and filed. So presently, if you look at NAFRA orders, there has been a lot of observations, and even the QRB reviews, there have been a lot of observation that there has been inappropriate assessment of risk of material misstatement, and even where the risk have been identified, they have not been properly documented as per the requirements of the standards. Now, if you look at the present standards 240 read with 315, so normally there are two risks which are presumed to be risk, but they are rebuttable presumptions, and these are revenue recognition and management overhead of controls. So in all cases, you need to consider these two presumed risks and document. In case you have not identified these as risk of material misstatement, you need to document the rationale for not considering these two as the risk of material misstatement. So this also has been an observation of NAFRA, that revenue recognition and management override has not been considered as a risk of material misstatement. Small entities, some entities, including less complex entities and particularly owner-managed entities, may not have established structures, processes, and systems. When such systems and processes lack formality, the auditor may still be able to perform risk assessment procedure through observation and inquiry. Other entities, typically more complex, are expected to have more formalized and documented policies and procedures. The auditor may use such documentation in performing risk assessment procedures. Yeah. Way forward, this is very important. So the first step is to establish SQM1 and SQM2 within the firm. Now we still have time to implement these two standards to establish the requirements. Because once the standard is notified, probably we'll have lesser time. The challenges are that, given the complexities and requirements of SQM1 and SQM2, there may be a requirement of a dedicated team to implement and monitor these two standards. Particularly in case of SQM2, one of the NAFRA observations has been regarding engagement quality control review as per SQC1, that either the engagement quality control review was not appointed or was not competent. Now, SQM2 talks about the requirements, eligibility, and qualifications of EQR in detail. So the firms would need to assess whether they need to, hire an external person to do EQR. This is allowed, and there are guidances available. So that also needs to be assessed. Assess whether these are meeting the quality management objective. You need to redraft the checklist for new standard that have been proposed, because drafting these checklists would also be a time-consuming process to incorporate various additions, and a checklist for all standards would need to be revised because they would be conforming amendments to other standards as well. And you need to identify what are the implementation challenges now and draw a plan which would probably require team, dedicated team, or hiring external agencies who would be taking up these as a assignment. Assess the requirements of new standards and map the resources available. That is, develop a plan to meet the gap. For example, as I said, EQR and IT professionals. So given the significance of IT in the revised standard, particularly SA 315, which has a 12-page guidance only on information technology, the firms may need to either hire a person with relevant qualifications or enter into a tie-up with a person who is specialized in this kind of a role, so as to meet the requirements of the standards. The firms must assess the additional effort required and sensitize the clients now for the additional time and fees. For example, increased cost due to IT professional in case of risk assessment. And if we look at the requirement of a proposed new SA 540 regarding counting estimate, there has been a significant change in the documentation requirements of the new proposed standard. So, a lot of additional time would also be required beside additional resources. So this would definitely lead to a higher cost and should result into a higher fee. So, we must, as practicing chartered accountants, ensure that we are appropriately remunerated. So, just a brief view, I have written a book, the second edition, published by Taxmann, on the audit of financial statements. Presently, it is in line with the existing standards in auditing, and it's a comprehensive guide covering all the stages of audit, right from the appointment till the archival of file, with detailed guidance and interlinking of various standards, auditing standards, accounting standards, companies at RO. So that's a comprehensive guide. Are there any questions? I will be happy to take. I don't see any questions in the chat box. Are there any questions? I mean, like, anybody has any questions, you can type in the chat box. Or in the Q&A section. So in case of any queries, participants can reach out to me. This is my email ID. This is my mobile number. On these standards or any other standards or any other matter related to auditing, I can be reached at this email ID and mobile number. So thank you. That's all from my side.